In dealing with debt, the trickle down from the Fed rate hikes is hitting Americans who want to buy homes or who have credit card debt that is sky high. Greg McBride, the Senior Vice President and Chief Financial Analyst for Bankrate.com, is keeping tabs on all interest rates. Joining us now. Thanks so much for being here, Greg. And what's your reaction to the aggressive tone by the Fed as the Fed is raising rates to fight inflation?
The credibility of the Federal Reserve regarding what's called price stability, in other words, keeping inflation low, has really been called into question in recent months. And so what we've seen is a much sharper tone from Fed Chair Jerome Powell and other members of the Fed in their recent public statements. And they really backed that up at this week's Fed meeting, making it very clear inflation is public enemy number one. They're going to continue to raise interest rates. And even when they're done, they're likely to keep interest rates at those high levels for a while. Trying to sort of vanquish this notion that a lot of investors had that the Fed was going to be very quick to cut interest rates.
The 30-year fixed mortgage is above 6%. What's your outlook on mortgages?
Mortgage rates have had a renewed surge. They've blown through that 6% threshold and they're still rising. Reason being, inflation has not yet started to cooperate. We haven't seen that sort of widespread moderation in price pressures that we need to see to really put a lid on mortgage rates. And the other thing is the estimate of just how high the Fed is going to have to raise rates and how long they're going to keep them there remain unanswered questions. And they're going to remain unanswered questions as long as the inflation picture is as it is. So we get a moderation in inflation. We get a little bit more visibility about how much further the Fed's going to go. I think that'll certainly help mortgage rates hit a ceiling. But until then, the bias certainly to the upside.
What's the latest on credit card interest rates?
The average credit card rate is now above 18%. That's the highest since the mid-90s, and they're still moving up. Credit card rates mimic the moves that the Federal Reserve makes. So another 0.75 percentage point hike by the Fed means your credit card rate's going to go up by 0.75 percentage point within the next couple of statement cycles. And the cumulative total year to date is what's really adding up. The Fed's raised rates by a total of 3 percentage points. That means your credit card rate's going to be 3 percentage points higher than where it started the year, and there is still more to come. So this credit card debt is a definite exposure to higher rates. You want to look for low rate balance transfer offers, do what you can to insulate yourself from the rate hikes, but also get that debt paid off once and for all.
What are some great tips for consumers?
I have 3 steps that consumers should be taking at this point in time. First, pay off high-cost debt, particularly that credit card debt that comes at a variable rate. Second, boost your emergency savings. Nothing's going to help you better weather whatever lies ahead economically than having some money tucked away. And third, keep making those retirement contributions. Don't bail on your investments. Keep making your 401k contributions. You've got to maintain that long-term perspective despite what I expect will continue to be a very volatile market. When you look back 5, 10, 15 years from now, you'll be really happy you stuck with it in 2022.
Thank you, Greg. We always enjoy your comments.
Thank you, Angie.
Go to businessfirstam.com for where to see our show on TV.